let's just jump right into navigating the One Big Beautiful Bill Act. I say that instead of OBBBA, or see, I think I said 4Bs there, because I can't say it. I always get it wrong. So I will go back and forth with that, but we're going to talk about the key insights for financial services. So briefly on our contact information here. Jess is the star of the show with all the knowledge on the tax changes. She's going to give us a run through of that. Before we jump into that, I'm going to talk very briefly on the current regulatory climate and the tie-in with the OBBBA. And our contact information is included here. If you ever want to reach out with any questions or anything else, let us know. And as always, the disclaimer. So I think this one rings especially true. The session here is for general education only and not legal or tax advice. It really reflects on the current interpretations that may change as subsequent guidance is released. And as you'll see throughout the presentation today, there's a lot of fine print in this new law. So we encourage everybody to seek that formal legal and tax advice where necessary. The agenda for today, we'll start with a high-level overview, the current regulatory climate and the new law, and then the most impactful provisions, including some individual, some business-specific, and credits and incentives. And remember, this is really only the tip of the iceberg, as I said, and then we'll close out with a strategic look at key takeaways before opening it up for a Q&A. So, starting out with the current regulatory climate, as of today, and really what matters for the One Big Beautiful Bill Act. So, regulators are recalibrating in 2025, as anyone who's followed along has likely seen. There's fewer peripheral exams and a renewed focus on core safety and soundness metrics, AML, and credit quality. So the CFPB is also formalizing a narrower standard, which just came out a few weeks ago in the comment phase still, for when it supervises non-banks, and the banking agencies have proposed rescinding the 2023 CRA rule and reverting toward prior rules. All of that matters for how banks document community impact and structure any OBBBA-driven financing. Going to our next slide. So first, lending and reporting. The One Big Beautiful Bill Act will change borrower economics. Think rural interest exclusions, bonus depreciation effects, things that Jess will talk about. And it may change the demand for certain loan types. Again, think of the expiry of EV credits and recent news along those lines. Regulators are also revisiting CRA, as we said, and loan reporting rules. So I would say it's important as ever to require clear documentation of borrower eligibility, underwriting rationale, and community impact metrics. If reporting of modified loans narrows, that might reduce some transparency, but examiners are still going to expect institutions to know their asset quality. So whether or not you need to for regulatory purposes or not, it's still important to have that information. Second, AML. New tax incentives can change transaction patterns. Examiners continue to emphasize SAR quality and third-party risk oversight. When designing any OBBBA-related products, community investment funds, or EV-related lending, ensure transaction monitoring captures the new flows and document tuning false positive reductions as well. Third, related to compensation, regulators ask whether pay plans encourage short-term revenue versus long-term credit quality. Ensure that your comp committee minutes reflect risk adjustments tied to credit and operational outcomes for any new products and new people driving those product teams. And the strategic opportunity. Finally, here, I'd say, marrying that tax advisory and compliance. Think offering clients OBBBA aware loan products that also generate CRA qualifying activity, but document the impact there. Create short impact reports. Metrics might include the number of jobs financed, loans by low or moderate income geographies, rural borrower credits. So exams see the program intent and the outcomes. And then a few quick points for what's next. Agencies are talking about regulatory relief that could affect exam scope. And I'd expect clarifying guidance on loan reporting and the treatment tied to the new tax rules. As for the other items listed on this slide, these are some high-profile proposals, rumors, or items included in previous drafts. And as it says in big red font, bold there, these are not in the final law, which Jess will be running through some of those next. There were no changes to the pass-through entity tax regimes. The proposed limits on SALT workaround deductions were dropped. There were no changes to the taxation of carried interests. The current long-term capital gains treatment remains intact. There was no decrease in the corporate tax rate. The 21% remains unchanged. There was no elimination of the Inflation Reduction Credit transferability. The clean energy credits remain transferable under the IRA rules. And no new corporate SALT deduction limitations. There were no changes to the deductibility of state and local taxes at the entity level. And, what, as it says to the right there in the bubble, will there be another reconciliation bill during Congress? Congressional Republicans, including Speaker Johnson, have publicly stated that planning is already underway for another bill to be introduced this fall. It may include tax extenders, work opportunity tax credit, empowerment zones, healthcare reforms, retirement and saving provisions, and maybe technical corrections, changes to the One Big Beautiful Bill Act for widely publicized items like the gambling loss limitation. It's really challenging, though, to utilize reconciliation based on the Byrd rule limitations that block non-budgetary provisions. And the midterm elections in 2026 could obviously influence the timing and the content of any bill. So I would say, we're expecting more targeted reforms, but fewer sweeping changes than the first bill. And of course, political and procedural hurdles could obviously shape what makes it into the final package. So with that, we will go to our very first code word, legislation. Which is a really good segue to Jess, who will cover what is actually in the legislation. And we'll give you a few seconds to get this code word. And I think Duran gave some comprehensive instructions, but if you need help, put that in the chat. And Jess, we will jump forward if you're ready.
I'm ready. Yeah, thank you, Mark. Great. So make sure you put legislation into your code words. Thank you, everyone, for being here today. We're going to get started kind of talking about the details of the law. So Mark gave us a great overview of kind of the environment that we sit in today. And, let's talk about what's actually in there. So huge piece of legislation signed into law July 4th of this year. Really robust. You can see listed on that first bullet point a bunch of the items that are included in this law. We're obviously not going to go through everything today, but we will try to hit the most impactful provisions for financial institutions. I will mention that when you do get the slides, the introduction slide that Mark went over with our biographies does have 2 links included in it. One to our One Big Beautiful Bill resource hub on our website, which has a ton of resources, articles, and FAQ for you to go through there. And then, of course, the contact us if you want more information, and both Mark and my email address are on there too. So encourage follow-up with any questions, because this is certainly a hefty bill. And as you can see in the last bullet point here, there's so many complexities to the provisions. We try to, as we put this presentation together, highlight some of those in red to make sure you can kind of notice some of the caveats and carve-outs that make the provisions maybe a little more complicated than they may seem at first brush. So be sure, as we're going through today, to kind of keep an eye out for those provisions, that kind of fine print that we wanted to mention. And I'll just pause and also just kind of two additional things to say. I agree completely with Mark's take on OBBB, and I won't say that all day. I won't take half of our time saying the letter B. I'll just maybe call it the new law, so you don't have to hear me stumble over all the B's today. But will there be a second reconciliation bill? It's interesting to see the dynamics on the Hill change as Congress members get back from recess and they face a funding deadline in just a few weeks. In the negotiations, and certainly their attention is on that right now, whether, what will happen as far as a continuing resolution, a potential government shutdown is certainly going to take some of their time and attention away from potentially another reconciliation bill moving through before the end of the year. So we'll see what happens there. And the last thing before we kind of get into the real meat here that I want to say is this is a huge piece of legislation, as I said, but it is certainly in some ways not the huge overhaul that we saw with the Tax Cuts and Jobs Act in 2017. This law really kind of takes the TCJA as a starting point, and a lot of the things that we're going to go over today are an extension of those TCJA provisions. So in some ways, kind of a continuation of status quo, and in a lot of times a permanent continuation of status quo. So I will go over that in detail for each provision, but that's high level where we're headed. So let's go ahead and kind of get into the actual provisions now. The first one I want to talk about is business interest expense, or 163J. So beginning in 2025, the new law restores the EBITDA-based calculation for adjusted taxable income under 163J. So basically, it's going to allow businesses to add back depreciation, amortization, depletion into their ATI calculations, significantly increasing the amount of interest expense that they may be able to deduct. So this is a big, impactful provision, especially beneficial for capital-intensive industries. From a financial services perspective, it's certainly going to improve the ability of borrowers to deduct interest expense. And, thinking about the impacts to banks, specifically, looking at loan activity, this is certainly kind of a shift in, or may cause a shift in client preferences, kind of back to borrowing rather than leasing. So we'll keep an eye on that long term, but a kind of a generous change in the ATI calculation and kind of an increase there as far as the deduction goes. Related for 179 expensing. So again, for 2025 onward, the new law increases the maximum Section 179 deduction up to $2.5 million and the phase out threshold to $4 million. Both those amounts will be indexed for inflation moving forward. So similar to bonus depreciation, which we're kind of about to talk about next, this provision is going to allow businesses to immediately expense the full cost of qualifying equipment rather than depreciating it over time. So, an expanded limit there, some more flexibility to manage taxable income. So kind of pairing this Section 179 expansion with bonus depreciation, which we'll talk about momentarily, clients can think more strategically and be a little bit more flexible as far as their expensing of capital investments. So a big headline one there. Certainly we'll see, based on this increase as in 179 expensing, more small and mid-sized businesses kind of investing in capital equipment, generating more demand for loans and leases. So certainly welcome news there. So another impactful one here with the expansion and increase in 179 expensing. Let's go ahead and talk about bonus depreciation. I've alluded to it already. It's certainly one of the big ones that we have gotten a lot of questions from clients about, and it's one of the most impactful provisions, certainly in the new law. So the full and permanent restoration of bonus depreciation for cost of qualifying property acquired and placed in service after January 19th, 2025. So this restoration of full and permanent bonus depreciation is tied to that January 19th, 2025 date. That is the date right before President Trump was inaugurated the next day. So basically, that's where that date comes from. And this provision eliminates the phase down schedule that was previously in effect under the Tax Cuts and Jobs Act. We had already seen bonus depreciation start to phase down, and it was set to fully sunset shortly. That phase down schedule is eliminated. So, some certainty for long-term planning is certainly helpful for businesses here. So a lot of red on this slide because the dates are really important. So the property has to be acquired and placed in service after that date. If property was acquired on January 19th, 2025 or before that date, it will still be subject to the old Tax Cuts and Jobs Act phase down rates, even if it is placed in service after the date. So you have to pay attention to both acquisition and placed in service date, as either could potentially disqualify the property from the eligibility for this 100% bonus depreciation. I've noted on this slide that the date of the written binding contract would be the acquisition date. So that binding contract rule is important to know if you're kind of trying to determine an acquisition date for potentially eligible property. So this is certainly going to kind of create some tax planning opportunities for banks, financial institutions. It could significantly reduce taxable income, especially, if a bank acquired qualifying assets, potentially new branch location, or makes qualified leasehold improvements. Those sorts of things could really be impactful here for this provision. And then the last bullet point on this slide, you'll note that there is a transitional rule for this first year, such that organizations retain the ability to elect out of bonus depreciation and kind of continue on that Tax Cuts and Jobs Act phase down schedule if that is desired and beneficial based on their tax situation. Okay, great. Qualified production property is related to bonus depreciation. This is essentially a brand new kind of type of property that's eligible for the 100% deduction. This is qualified production property, or QPP. So it's going to be newly constructed non-residential real property that's used for manufacturing, production, refining of tangible personal property. So again, you can see there's dates in red on this slide. So some important eligibility considerations, because to qualify for this new 100% bonus depreciation category, the construction of the eligible property would need to begin again after that January 19th, 2025 date. And then the property must be placed in service before January 1st, 2031. So this is for new buildings and improvements. It does exclude portions of the property that would be used for non-production activity, offices, administrative, parking, those sorts of things. So it's temporary. You can see, it's only for this window as noted here, and kind of targeted at a very specific type of property, but certainly very beneficial for potential investment in physical production infrastructure. So we'll keep an eye on this provision and see how it impacts lending, borrowing, and that sort of thing. I will say, because it's a brand new category, we haven't previously seen a bonus depreciation eligibility kind of building or envelope category in the past. We think this one will be an early item for some Treasury guidance. So we're keeping an eye out for that to be coming out soon. All right, great. So we're at our second code word. So I will pause there to give you time to enter the word depreciation into Conferences.io. We've been talking about bonus depreciation. So go ahead and put depreciation into your code word section. And again, please feel free to put questions into the chat as we move through, and we'll hopefully retain some time at the end to get to those. Depreciation, code word number 2. Okay, moving right along. Our next topic is excess business losses. So this one's effective for 2026. So you can see as we move through, some of these provisions kind of went retroactive to the beginning of 2025. Some are tied to that January 19th date. This one's 2026 onward, as a bunch of additional provisions are. And actually, we have some that are tied to the date of enactment of the law. So again, just really important to keep in mind the specific effective dates that we tried to highlight in red here for you. So as far as EBL goes, 2026 onward, the excess business loss limitation and carry forward rules were made permanent in the new law. So you can see here the utilization of carry forward excess business losses will be treated as net operating losses and also permanently extended there. I just put a note under the second bullet point as far as the carry forward goes, that there was talk and there was a previous version of this legislation that proposed limiting carry forwards to be business income only as far as their treatment goes. That was not in the final bill, but it's worth noting because certainly as this bill was moving through the process and prior to it being signed into law, there were so many different versions. We saw so many different headlines. It's easy to potentially think something made it into the final law that did not. So I wanted to call that out there. You can see the thresholds listed for EBL on this last bullet point here. Those are going to revert back to 2018 levels. They will be indexed for inflation, and you can see the thresholds there for single and joint filers, both the new thresholds and the previous ones. Also with EBL, there's some important state level coordination to consider. So for instance, someone could have pass-through losses, creating an excess business loss that are addressed in the way you see on the slide here at the federal level, but they may need to be added back in when calculating state level income. I know that's the case in New York State. So think about state level coordination with that piece as well for EBL changes. Okay, great. Qualified business interest deduction, or 199A. So the QBI deduction, generally, this is going to allow eligible taxpayers, owners of pass-through entities like solar proprietorships, partnerships, S corps. They are allowed to deduct up to 20% of their qualified business income on their personal return. So there was discussion. This is, again, one you may have seen headlines around in previous versions of the bill. That 20% number did bounce around a little bit in other versions, but the 20% number did not change in the final law. And that deduction was made permanent for 2026 moving forward. Additionally, as you can see in the last section of this slide, under the new law, the income ranges where the qualified business interest deduction phase out have been widened. So this is going to generally allow more taxpayers to get the deduction, and even potentially allow more taxpayers to get a partial deduction if they're earning above those thresholds. So a widening there of QBI eligibility for that 20% deduction. Okay, so this is a big one as well. Research and experimental expenses, R&E, often called R&D. So the new law repealed the Tax Cuts and Jobs Act requirement to amortize domestic R&D expenditures over 5 years. So businesses may now immediately deduct eligible US-based or domestic R&D or R&E expenses for tax years beginning after 12/31/24, so 2025 onward. You'll note that there's no change to foreign R&E expenditures. Those must still be amortized over the 15-year period. Also, taxpayers with remaining unamortized domestic expenses from 2022 to 2024, they may choose to continue as scheduled with that amortization or to accelerate the deduction that remains over 1 to 2 years. So a choice to be made there. Importantly, as you can see in the second half of this slide, small businesses or those with average gross receipts of less than $31 million also have an option to elect to apply the new rules retroactively back to 2021, or I'm sorry, back to the tax years beginning after 2021, so 2022 to 2024. So this specific provision, as far as the retroactive determinations to be made around the changes to R&E expenses, actually resulted in, a little over a week ago, the IRS releasing Revenue Procedure 2025-28, which has details on basically how to make the elections around the changes to R&E treatment, changing accounting methods where necessary, filing amended or superseded returns. And it also has information about how these changes and elections made regarding them might interact with R&D tax credits as well. So we've been going through that RevProc with clients now as they assess, because of kind of the potential retroactivity, what is the best decision for them to make around these changes and how to actually go about making those elections and reporting those changes to the agency. So a ton of information in RevProc 2025-28. Okay, awesome. So corporate charitable contribution deductions, some interesting changes here under the One Big Beautiful Bill Act. So there is a new 1% floor, which essentially means that corporations can only deduct their charitable contributions that are above 1% of their taxable income. And then the existing 10% ceiling or cap on those deductions remains in place. So you can only deduct up to 10% of the corporation's taxable income. So I think one of the best ways to kind of think about how this plays out is the example in blue here. So let's say we have a corporation with $5 million in taxable income. If they contribute less than $50,000, in that case, there's going to be no deduction allowed because they've not cleared that new 1% floor that this law introduces. If their contributions do increase and they're anywhere between 50,000 to 500,000, then they would be able to deduct the amount above the 1% floor, above that 50,000. In this case, in my example, where it's kind of in that range of 50,000 to 500,000, there would be no carry forward amount. They would deduct the entire amount. If their contributions were in excess of 500,000, then they would be able to deduct basically the total amount between the 1% floor and the 10% ceiling. And then the excess amount that they were not able to deduct based on that, the ceiling and the floor interacting, those amounts could be carried forward for 5 years. So an interesting new wrinkle that may assess any kind of charitable contributions that your organizations are making moving forward. Okay, great. Information reporting requirements. So this is really around 1099 forms, specifically 1099 miscellaneous and 1099 NEC forms. The reporting threshold for those forms has been increased under the new law from $600 to $2,000. So essentially, businesses and payers will only need to issue these forms if a payment to a vendor, contractor, service provider for the total calendar year is in excess of that $2,000. So we're anticipating fewer 1099s required to be prepared on an annual basis, so some welcome reporting relief there. For 1099K, those reporting thresholds were reinstated back to the thresholds that were in place before they were changed under the American Rescue Plan. So for 1099K, which those are the forms that are prepared by third-party payment services, PayPal, Venmo, Square, and the like, the American Rescue Plan had reduced the reporting requirements significantly. And then the IRS actually had kind of delayed implementing the change over time. There was some interim kind of transitional thresholds that they rolled out. But what the One Big Beautiful Bill Act did was remove those previous thresholds and reinstate the original threshold retroactively. So you can see it's retroactive from 2022 onward. So it's almost as if they were included or extended in the American Rescue Plan originally. So fewer taxpayers will get these forms based on that threshold increase, probably less kind of confusion for those folks that sell personal items, receive payment through payment apps, that sort of thing. So some welcome increases to the thresholds around 1099 reporting here.
Just a skeptical question, I suppose,
Yeah,
on the 2022 retroactive change.
yeah.
So whether you get the form or not, you're still obligated to pay the taxes. So to say that, well, retroactively, it doesn't exist anymore. I mean, it was already reported. So I'm confused by the retroactive part on that one.
Yeah, I mean, it really depends on, yes, you're right. For those years that have already occurred, and certainly people who have already received 1099s for those years, that's not going to change for them. But if there are returns, if there are tax years that are still open or things like that, that this would affect those retroactively going back. But to your point, for most people, those years are either done and dusted, or they, like you said, they're paying the tax regardless of the reporting piece. Good question. Okay, this is one of my favorite ones to talk about, because this has gotten a ton of headlines. You've seen everywhere no tax on overtime in the headlines. And of course, like with everything in legislation, it's not quite that straightforward. So let's talk about this new overtime deduction. The One Big Beautiful Bill Act introduced a new, and it's temporary, it's for years 2025 through 2028, above the line deduction for qualified overtime pay. So there is a limit. It's going to allow for up to $12,500 of qualified overtime pay, or $25,000 for married filing jointly. And it does phase out based on modified adjusted gross income. So if that income exceeds the thresholds listed here on the second bullet point, then the deduction will no longer be applicable. A couple of really important caveats to note while we're talking about the overtime provision. This deduction is only for the premium portion of overtime pay. So, put in plain language, if an employee is paid time and a half for overtime, it's the and a half portion of that pay that's going to be deductible. So, really, only that additional overtime premium that will be allowed to be deducted. And it is a deduction, so this doesn't change withholding. Importantly, there is still potential taxes on overtime pay, so payroll taxes, state and local taxes. So not entirely accurate to just say, hey, no tax on overtime anymore. And a lot of this is applicable also to, I'll just mention, no tax on tips, which is getting similar headlines. We didn't include it in this presentation because we, are keeping our focus on financial services to really focus on what impacts you and your organizations, where tipping is not, you're not an occupation ordinarily tipped, and thus we didn't get into the details, but similar caveats for that provision as well. And certainly if that's something that impacts you, we're here to help through that too. There is a transitional rule in 2025, as with a lot of these provisions you've seen, if they're going back to the beginning of this year or even further back, there's going to be some transitional relief. So for the purposes of this current year, the IRS has said that employers and payers may use any reasonable method to determine and report the qualified overtime compensation separately from regular wages. So this is not yet on the W-2. So, it won't be easily reported there for this current 2025 tax year. I will mention the IRS has released their 2026 draft of the W-2, and it does have changes to allow for tip income and overtime income to be reported separately on the form. So, now is the time to certainly make sure your tracking and reporting is ready for this change and ready for that change to the W-2 in future years as well.
Just quick
That's,
question,
yeah.
clarification. The payroll tax piece, now, as I recall, that was because they couldn't touch that via the reconciliation process. One, is that correct? And then two, do you ever see any movement on that? I mean, it seems like, at least in the election, both parties were for it, but I know they wouldn't want to necessarily give the other side a win going into the midterms, I would assume, but they would, as I understand, they would then need to do this outside of the reconciliation process and get this regular 60 vote majority in the Senate, right?
So that's interesting, Mark. The theory that not being able to make this tax-free from a payroll tax perspective was due to running afoul of the Byrd rule. I did not read that. It's possible. And I'm sure I know we've got folks on the call who may know the answer to that question, but I was not aware of that. If that is the case, then your point is absolutely correct that if that's the reason, then that's, it won't be touched in future reconciliation. It would have to go through a regular legislative process with a higher vote threshold burden, which is certainly a consideration as we watch the makeup of Congress in the coming months. There's a couple of special elections coming up that could potentially even further narrow already very narrow margins. So anything becomes really a razor thin vote situation. I do think for the tax and overtime provisions specifically, like you said, there's bipartisan support for these provisions, and the parties kind of consider these to be wins as far as what was included in the final law. A lot of Americans, if you ask them right now, what did the one big beautiful bill change about tips and overtime, they would say they're tax-free now. We've kind of talked about how that's not necessarily the case, but from a public perspective, I think they're relatively happy with where they landed on these provisions. So I don't know that there'll be movement on that piece in the future. Good question. Okay, Trump accounts. So these are, it's another brand new provision in the law. These accounts did not exist before the One Big Beautiful Bill Act. So these accounts will function kind of similarly to a Roth IRA as far as their investment kind of restrictions, early withdrawal rules, that sort of thing. You can see the details on this slide, but essentially these accounts will be active and able to begin contributions 1 year from the date of enactment of the law. So that would be July 4th of 2026. So you can see the annual contribution limit is $5,000, and there is up to $2,500 employer contribution. That if there is an employer contribution, that would count toward that $5,000 limitations. But it is tax-free, so it's excluded from income for the recipient, and as far as the employer side, it would be deductible to the employer. Additionally, there's a one-time $1,000 deposit from the federal government for children born between 2025 and 2029. The indication from the agency as to how that will work is that it would be automatically issued based on Social Security. So there would be no need for parent or employer contribution to be required to receive that one-time distribution. Interestingly, that $1,000, that one-time $1,000 from the government would not count toward that annual maximum, that cap of $5,000. So interesting there. You can see the withdrawal rules are laid out at the end of this slide. But again, there's potential early withdrawal penalties and kind of acting like a Roth IRA in that sense, as you can see here. So for 529 plans and ABLE accounts kind of function similarly, of course, for families, children with disabilities and their families. But we did see some changes and expansions to these accounts. So for 529 plans specifically, we have some expanded qualified expenses for payments that are made 2026 onwards. So for elementary and secondary kind of K through 12 costs, they've expanded beyond just tuition to include books, tutoring, online platforms, educational therapies, those sorts of things. Additionally, the annual distribution limit was increased. It was doubled from $10,000 up to $20,000 per beneficiary for those K through 12 expenses. And additionally, they can now be applied to public, private, or religious schools as well. You can see here on I guess the fourth sub bullet under the 529 plans, that additionally for payments made after July 4th of this year, there's some post-secondary credentialing expenses that could be eligible as well. So vocational training, licensing exams, continuing education, those sorts of things would be included. As far as the ABLE accounts go, we saw the permanent extension of the contribution limitation that exists there, and the permanent ability to kind of roll over 529 plans to ABLE accounts. Additionally, the able to work provision was extended, and the savers credit eligibility was also extended. So as far as ABLE accounts go, we saw basically a permanent extension of the provisions around those.
Jess, on the 529 stuff, I do remember
Yeah.
the first time around, the big reporting was that it doesn't change the way it's handled at the state level. I know every state's a little different.
Mm-hmm.
I guess I would just say that that's the same cautionary piece that's
Yeah.
out there.
That's a really good point. And that goes for so many of these provisions as far as kind of state conformity and monitoring things at a state level, because, we're talking about a federal piece of legislation, and certainly the states may differ and often do. Okay, our third code word is deduction. So please go ahead and put deduction into conferences IO for your code words there. Third code word is deduction. Deduction, deduction, deduction. Make sure you enter it. All right, a few more provisions, specifics for me to get through before I turn it back over to Mark. So as far as the home mortgage interest expense goes, so for 2026 onward, the loan cap, that $750,000 cap for deductible mortgage interest, is made permanent. So this really kind of just reinforces the post Tax Cuts and Jobs Act standard. As far as removing the sunset, there's some certainty around advising clients, loan structuring and tax planning around home mortgage interest expense. Mortgage insurance premiums remain deductible, preserving the incentive for kind of lower down payment borrowers. Home equity interest remains disallowed here, unless that money is being used to buy, improve, or expand on the home. So of course, the purpose of the funds does matter when you're considering potential home equity loan eligibility around this. So given that all of the changes on this slide for home mortgage interest expense kind of kick in for tax years beginning after December 31st of this year, so it's 2026 onward, there is some time for banks, financial institutions, and the like to consider, if there are any necessary adjustments around marketing disclosures, client guidance here. So a little bit of planning time to adjust here. And I see a question in the chat. Our last code word was deduction. Speaking of deduction, another new provision allows for an above the line write-off of up to $10,000 of qualified interest on passenger vehicle loans, so car loans, per year. This is available on loans that originated after December 31st, 2024. So you can see it's another temporary provision, that 2025 through 2028. It does have some income-based limitations, whereby the deduction is going to be phased out, as you can kind of see in the second bullet point here. So keep an eye on that. And this is really going to be available for new U.S. assembled cars, so not leases, not commercial use, fleet use, that sort of thing. We are keeping an eye on the last bullet point here as far as new information reporting requirements go. So some new lender reporting will likely be required here, specifically Form 1098-V. So you got to kind of keep an eye on the amount of interest received in the calendar year, and if reporting requirements will kick in such that the lender will have to report some information on, the amount of the loan, the principal balance outstanding. It will need car information to ensure it's an eligible vehicle. So, like many of the other provisions we've been talking about today, especially those that go into effect retroactively, we're anticipating additional guidance, potential change into forms, and things that we'll see the IRS releasing in the coming months.
This one obviously could have an impact on your customers. So
Yeah.
I don't think it changes the way you need to report things, but I guess you never know.
Hmm. Yep, exactly.
Well, actually, as I say that, I think it through. Like you don't get a 1098 or 1099 or 1098 in for that auto loans. So I would assume now that you would need one.
I think that's right, Mark. I think that's exactly right. That form 1098B is going to, my understanding is that when there's greater than or equal to $600 of interest received, eligible interest based on this here in the calendar year, that form will be required. Yeah, but we have to keep an eye out for the guidance around this. Okay, the interest on loans for rural and agricultural real property. So this is a new 25% exclusion from gross income of the interest on new real estate loans secured by U.S. farms, ranches, fishing, seafood, and the like. So, for those on the call, we certainly want to kind of consider potential impacts here on effective tax rate. If you do have significant agricultural lending, this is certainly one to be aware of, as the qualified lenders would be U.S. banks, their subsidiaries, insurers, the farm credit system institutions. So, it's an interesting provision. It's that new 25% exclusion. But interestingly, because the lender is able to leave 25% of the interest that it earns on these qualifying loans out of their income, that 25% is now tax exempt. And then we actually see Section 265 kind of step in. And there's a wrinkle whereby now that money is tax exempt, that 25% interest expense would be non-deductible. So these are the kinds of things where you kind of need to keep an eye out, where 265 is kind of denying a matching 25% slice of that lender's interest expense, on the funds borrowed to carry the loan. And again, this is where things can kind of get complicated, and we're here to help. Our team is here to help, but you really kind of do need that expert help to make sense of how some of these provisions kind of interact with each other and some of the trickle down effects here. Okay, the excise tax on remittance transfers or outbound transfers. There's a new 1% federal excise tax, but importantly, the tax is not applicable if the funds are debited from a depositor brokerage account with a Bank Secrecy Act regulated bank, U.S. credit union, broker dealer, or if the sender uses a U.S. issued debit or credit card. But still, obviously, something we wanted to make you aware of, as the provision is in place effective for transfers after 12/31/2025, and just analyze remittances to ensure that your customers are excluded, which they likely are. Qualified small business stock. So this is section 1202. This is, kind of a powerful capital gains exclusion for investors. And you can see some of the changes and expansions made here. This was one that caught people off guard, all the speculation of what would be in the One Big Beautiful Bill Act. This was not really on the table, expanding this kind of already generous provision. But there was a per issuer gain exclusion cap increase up to $15 million. You can see the changes to the exclusion schedule there as well. So certainly going to allow more late stage startups and capital intensive businesses to qualify for treatment under this. So, keep an eye out. There's no change as far as the qualified or disqualified businesses. So as far as banks go, banks remain investors, not issuers of qualified small business stock.
And for whatever it's worth, I mean, at least anecdotally, I'm seeing a fair amount of noise around this one, and
Mm-hmm.
companies considering converting to C Corp so they can get ready for this and raise funds and those kind of things. So it's definitely a significant
Mm-hmm.
advantage.
Yep, exactly. Okay, and one last one. This actually wasn't technically in the One Big Beautiful Bill Act. This is a change kind of carrying over from the Tax Cuts and Jobs Act in a sunset that's coming up that we just want to make sure employers are aware of. So essentially, employer provided meals on business premises for the convenience of the employer were 50% deductible through, or are 50% deductible through the end of this year, 12/31/2025. And then after that date, the deduction is set to schedule to expire entirely. The OBBBA does not reverse that sunset. So, instead it essentially codifies the disallowance of the deduction for most employer provided meals beginning next year. There are some limited exceptions to that to be aware of, but employers should really kind of keep an eye out on this looming sunset and just kind of review meal policies, snack policies, document eligibility for exceptions, and kind of ensure that they're maximizing any potential ongoing deductibility here. Okay, I'm going to stop and turn it over to Mark as we have a few more slides to cover. Thanks, Mark.
All right, so we opened with what's not in the bill. Just talked about what's in there, and now we're kind of closing with what the bill takes out of existing law. So OBBBA, since no one said that in a while, accelerates the sunset for many IRA credits, Inflation Reduction Act, signaling a policy shift away from green energy incentives. Businesses and individuals really should act quickly to take advantage of these credits before they expire. As highlighted here, 179D and 45L, the elimination of two key tax deductions and credits for energy efficient construction. The 179D deduction for designing and constructing energy efficient commercial buildings, it is terminated for properties where construction begins after June 30th, 2026, so next year. The 45L credit, which provided a credit for construction of new energy efficient homes, is removed for homes acquired also after June 30th, 2026. These eliminations will directly impact contractors who specialized in or relied on these incentives to drive business in energy efficient design and construction for both commercial and residential properties. It's a slightly longer runway for construction and planning, but still an often used deduction that will be going away in less than a year. And then prevailing wage and apprenticeship bump ups remained untouched. Going to the next slide, OBBA also brings an early partial sunset to two of the main business credits originally extended under the Inflation Reduction Act. The 12-month grace period from enactment gives developers a limited window to start construction and still qualify under the old rules. The accelerated termination applies only to wind and solar, though. Other technologies like geothermal, hydropower, nuclear, these retain the original Inflation Reduction Act phase out schedule under both the PTC and ITC, 45Y and 45E or 48E. There also was an executive order directing the Treasury Department to begin the guidance process on foreign entity restrictions, and also for agencies to strictly enforce the rollback of these wind and solar credits. And then a few weeks back on August 15th, IRS issued notice 2025-42, outlined here at the bottom of the page, regarding the clean energy tax credits for wind and solar projects under these two credits, which clarifies when the beginning of construction is deemed to occur for wind and solar facilities seeking eligibility for clean energy credits. as I zip through here in the final few minutes. On the employee retention credit, so retroactive changes the expands the penalties, and there are some constitutional concerns around the retroactive claim cutoff, even for valid claims, but it remains in effect unless changed in litigation or overturned. And I'm not aware of any such litigation just yet, but it remains to be seen.
Agreed. To be
There's
determined, right?
there's no carve out of safe harbor for taxpayers who filed in good faith after the cutoff date, and businesses and advisors must now treat ERC claims with the same level of scrutiny and documentation as income tax filings. The last code word, and I'm sure everyone will disappear after this one, but we do have another slide, is credits. Credits, C-R-E-D-I-T-S, credits. And I'm sure Susan's note taker will put that in the comments. So strategies and key takeaways. The One Big Beautiful Bill Act introduces obviously a robust combination of tax policy and incentives designed to fuel investment across construction and real estate industries. And, we have expansions and rollbacks. And while there's a lot here that we've seen, like I said at the beginning, it's really just the tip of the iceberg, and there will be guidance from IRS and Treasury, proposed and final revenue procedures and rulings and new forms and instructions, notices, FAQs, announcements, etc. So that will really dictate how these high level changes will be administered and processed. And often with that forthcoming guidance, there are comment periods for industry feedback, which further extend out that ramp. So it's important, do some modeling, update your pro forma models, incorporate new opportunities with focus on timing, maximize any tax deferral opportunities that may exist, consider cost segregation studies to identify assets eligible for accelerated depreciation. Accelerating capital investments might make sense to take advantage of 100% bonus depreciation and expanded 179 expensing. And then planning around SALT deduction changes and other temporary provisions. Strategic planning is essential to maximize benefits, deferring income, accelerating deductions, improving cash flow, and staying compliant along the way. And the law creates opportunities for innovation, investment, and succession planning. But as we talked about earlier, there's obviously also many challenges we must navigate. Those highlighted throughout, along with the potential state conformity issue that we talked about. For deductions for overtime, most states start with AGI and are going to align with the federal level deductions, but it remains to be seen. And states may want to decouple as a revenue raiser. This is a federal only deduction, so we have to watch the states, and we'll know more as the year goes on. But we usually see this kind of legislation we usually see this with this kind of legislation. So a lot of stuff remains up in the air, but again, there's a lot of new provisions and a lot that remains uncertain at this point. But we do appreciate you joining us. And if you have any questions, as always, feel free to reach out. Our contact information was included at the beginning. And I see no additional questions in here, but as Duran put in there, don't forget to log out and we will be getting you your information on your CPE, and the slides will be shared as well. Again, thank you as always for joining us.
Thank you, everyone. Have a good day.